Your first $1,000 investment matters more than your next $100,000. Most people think investing is about getting rich fast or finding the next moonshot stock. They spend months waiting for the perfect time or overthinking which app to download. But the truth is, your first $1,000 isn't about the money, it's about the habit. It is the seed that determines whether you will build a forest or remain a spectator for the rest of your life. Today, I am going to show you exactly how to invest your first $1,000 in 2026, step by step, with zero hype and total clarity. Why is the first $1,000 so special? Because it is where your behavior is trained. When you have $0 invested, you are a consumer. When you have $1,000 invested, you are an owner.
This first 1,000 teaches you discipline, consistency, and most importantly, patience. If you can learn to manage $1,000 without panic when the market dips 5%, you will be able to manage $1 million later. The math is simple, but the emotions are complex. We start small to master the person in the mirror before we try to master the market. In 2026, the world moves faster than ever. Information is everywhere, and everyone has a hot tip. But the fundamentals of wealth have not changed in 100 years. This is not trading. This is not gambling. If you are looking for a quick flip, this guide is not for you. We are building a system. The first investment is designed to build your confidence, not your instant income. We are moving from the active world of earning to the passive world of owning. Before you put a single dollar into the market, you must clear 3 hurdles. If you skip these, your investment will feel like a burden rather than a blessing. 1. The Starter Emergency Fund. Do you have at least 1 month of expenses in a high-yield savings account? If not, do that first. Investing without a safety net is like skydiving without a backup parachute. 2. The Debt Audit. Do you have credit card debt or loans with an interest rate higher than 15%? If you do, pay those off first. Paying off a 20% interest credit card is a guaranteed 20% return on your money. No investment in the world can consistently beat that. 3. The Time Horizon. Is this money meant for a house down payment next year? If so, do not invest it. The stock market is for money you don't need for at least 5 years. Time is the only thing that reduces risk. Your first $1,000 needs a safe place to live. In 2026, you have endless options, but simplicity is your superpower. Choose a major, low-cost brokerage, Fidelity, Vanguard, or Charles Schwab. Do not open 5 different accounts. 1 platform, 1 login, 1 goal. If you are in the US, consider a tax-advantaged account like a Roth IRA. If you are elsewhere, look for your local equivalent. The goal is to minimize fees and maximize ease of use. As a beginner, you will be tempted to buy individual stocks like Tesla, Apple, or whatever AI company is trending this week. Resist the urge. Buying individual stocks with your first $1,000 is like trying to fly a plane before you've learned how to drive a car. Avoid hot tips, avoid crypto speculation, and avoid complex options. At this stage, your job is not to find, quote, winners. Your job is to own the market. The ideal vehicle for your first $1,000 is an index fund or an ETF, exchange traded fund. Think of an index fund as a basket. Instead of buying 1 apple, 1 stock, and hoping it doesn't rot, you are buying the whole orchard. An index fund tracks a group of companies. For example, the S&P 500 tracks the 500 largest companies in America. This gives you instant diversification. If one company fails, the other 499 carry you forward. It removes the pressure of having to be right. Here is exactly how to split your first $1,000 for a balanced, beginner-friendly start. $700, 70%, into a total stock market index fund. This is your engine. It gives you exposure to thousands of companies across every sector. $200, 20%, into an international index fund. This is your shield. It gives you a piece of the action in Europe, Asia, and emerging markets. $100, 10%, held as cash or a money market fund inside the account. This is your psychological buffer. Within the first few months, your $1,000 might become $950, or it might become $1,050. Many beginners see $950 and think, "I've lost $50. I need to get out before it hits zero." This is a fundamental misunderstanding. You haven't lost anything unless you sell. The market is like the ocean. It has tides. It goes up and it goes down. Your job is not to predict the waves, but to stay on the boat. Volatility is the price of admission for long-term gains. Once your first $1,000 is settled, the most important step follows: automation. Set up a recurring transfer, whether it's $50, $100,
or $500 a month. Make it automatic. This removes decision fatigue. If you wait until the end of the month to see what's left over to invest, the answer will usually be zero. Investing is a bill you owe to your future self. Pay that bill first. One of the hardest parts of investing is doing nothing. In 2026, your phone will give you notifications every time the market moves. You will see breaking news designed to make you panic. Ignore it. Successful investing is boring. If you find yourself checking your account balance every day, you are over-monitoring. Check it once a month to ensure your automation worked, and then go live your life. As you own these funds, they will pay out dividends. This is the company sharing its profit with you. When you are starting out, always select Reinvest Dividends. This means the money automatically buys more shares. This is how the snowball effect begins. More shares create more dividends, which buy more shares. In the beginning, it's pennies. In 10 years, it's a landslide. 1. Overtrading. Moving money in and out of the market trying to time the bottom. 2. Chasing past performance. Buying a fund just because it did 20% last year. 3. Stopping during a crash. The sale mentality. When the market drops, that is the best time to invest more, not less. Why not just keep the $1,000 in a shoebox? Because of inflation. Inflation is the silent thief that makes your money buy less every year. Investing is the only way to protect your hard-earned money from losing its value over time. You aren't just trying to get rich, you are trying to stay relevant. Let's be clear. $1,000 is not going to change your life next year, but it will change your future behavior. It builds the neural pathways in your brain that value long-term rewards over short-term dopamine. The real return on your first $1,000 is the education you receive by being in the game. Think of this $1,000 as a seed. If you plant it and keep adding water, it grows. Over 30 years, at an 8% average return, that $1,000, combined with just $200 a month in contributions, grows into nearly $300,000. The math of wealth is simple. Small amounts plus consistency plus time equals freedom. Your goal for the first year is simple. Stay the course. Don't change your strategy. Don't listen to your cousin's stock tip. Spend this year reading 1 or 2 classic investing books. Observe how you feel when the market goes down. Learn your risk tolerance. This first year is your apprenticeship. One advanced concept you should understand even as a beginner is that down years have a hidden benefit. If your $1,000 investment drops in value, you haven't just lost potential profit. You've gained a tax advantage known as tax loss harvesting. In many jurisdictions, you can use these paper losses to offset future gains or even your active income. This means even when the market is red, the government is essentially subsidizing your patience. While everyone else is complaining about a market dip, you can smile knowing your future tax bill is shrinking. This is how the wealthy think. They see opportunity in every color of the chart. In 2026, protecting your investment is just as important as growing it. Your brokerage account is now a prime target for digital thieves. Before you deposit your $1,000, you must enable multi-factor authentication, MFA. And not just the SMS kind. Use an authenticator app or a physical security key. Treat your brokerage login with more respect than your social media. A single hack can erase years of compounding. Set up account freeze features if your platform offers them. Wealth is built through growth, but it is kept through security. By 2026, most major brokerages have integrated AI co-pilots to help you manage your funds. While these tools are incredibly powerful for tracking your spending or calculating your taxes, you must use them with caution. The AI can provide you with data, but it cannot provide you with conviction. Do not let an algorithm talk you into selling during a market correction just because it's optimizing for short-term risk. Use AI to automate the boring stuff, like rebalancing your portfolio or finding low-fee alternatives. But keep your human brain in charge of the long-term vision. The machine understands numbers, but you understand your dreams. Starting is more important than being perfect. You don't need a finance degree to build wealth. You just need the courage to take $1,000 and put it to work. Wealth is built slowly, with patience, with discipline, and with time. You have the guide, you have the strategy. Now the only thing left to do is take the first step. If you're ready to put your first $1,000 to work in 2026, hit the like button and subscribe. We focus on the strategies that actually work for regular people.
Drop a comment below with the word started if you've opened your account this week. I'll be there to answer your questions and help you through the first few hurdles. Your future starts the moment you stop waiting and start investing. See you in the next one.